Wow, one man sent the market plunging 1,000 points. Let's get into why that happened and what's about to happen. Let's begin by looking at pain is coming. That's according to Jerome Powell. I'll give you the details right here. You can see it for yourself. Powell comments fuel 1,000 point market rout on Friday as stocks slide for a second week. So you have a situation in which the market was really truly hoping for a little bit of dovishness, or at least in what I explained in the video previous to this, a neutral level. Neutral level. Now, there are a lot of technical indicators that were being set up at this point. To anybody who saw the community post or the blog section of my channel might have come up in your feed, I discussed the fact that there's something else happening here other than necessarily Jerome Powell's statements. There's another level to it, and I'll bring that to you here in today's video. So you can see that what he had to say was quite strong. And there's this message back and forth of, are we going to be hawkish? Are we going to be dovish? And what does the Federal Reserve actually intend on doing? Because they can say one thing and they can do another. At this time, both aspects have been in line. They have suggested over and over again, we've got to keep inflation down. And they have said, we're going to keep doing this until inflation is down. When you look at their actions, they've been increasing interest rates, I wouldn't say dramatically, but at least compared to where they were, certainly they have done so. Restoring price stability will likely require maintaining a restrictive, remember that, restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. Now, I had discussed this in the video previous to this one. I have said this even before. The 1970s looks a lot like what they're trying to avoid right now. This is something I've been warning about for a while, and why I believed initially that the Federal Reserve will increase interest rates. There were many who said, that's impossible. I've been true to that message, and here we are still right now, despite so many people saying, no, this is it, that's it. They are doing so, and we will see interest rates at least 3% in a month from now. Okay, so looking at this, they don't want to do the 1970s thing, which was basically, well, we'll increase interest rates, and then as soon as we start to see things turn around, okay, we're going to hurry up and cut them. And then what happened? Well, of course, you saw interest rates needing to be put at a historic high in order to quell the inflation. That's what they're trying to avoid. And not only, that's not me saying that, that's literally Jerome Powell now. We have those quotes. So there are many people like this individual they're just getting into here that, is the Fed hawkish? Are they not going to be hawkish? Not hawkish enough? Is it dovish? Is it neutral? All these things. As far as I'm concerned, their message has been the same throughout. Look at this. Powell warns of, quote, some pain ahead as the Fed fights to bring down inflation. For those paying attention to this, understand how important and pivotal it is, not just for the markets as a whole. These are all companies that are involved here, and they have people that they hire and people that they could fire, and certainly jobs will be affected by what happens in the next few months. They've already started to lay off people, but it's been a small percentage. If we see unemployment rise, not that much, mind you. If we do see unemployment rise, and we're talking about the U3 unemployment rate, watch out. And we'll talk more about that. The most accurate right now, the most accurate Wall Street analyst had some words to say. If you want to know what that is, stay to the end of this video. I promise I'll bring that to you. If you find this video valuable, all you got to do is subscribe, and I'll bring you more of these details. Looking at this here, Fed Chairman Jerome Powell on Friday pledged that the central bank will use our tools forcefully to attack inflation. You could see here, Powell added that higher interest rates likely will persist for some time. The historical record cautions strongly against premature loosening, as you saw before. So you see that. You see what they're doing. This was not expected by the vast majority of financial analysts, whether we're looking at the mainstream regurgitators or coming from the alternative regurgitators. This is not the expectation. Okay, what about this? The looking at what happens here with the economy, with job losses, and he says that these are the unfortunate costs of reducing inflation. But a failure to restore price stability would mean far greater pain. What is he saying here? If we have to see higher levels of unemployment, if we have to see job losses in order to bring down inflation, we will do that. And let's be honest, if you're going to use the U3 unemployment rate, right now we're at a historic low. If you bring up unemployment to 5%, okay, that's still what they consider to be full employment. So not a big deal. Not a big deal at all. So they're willing to do that. Inflation levels are too high. You look at the jobs numbers in general. You look at any of the points that they like to, and they can actually do. And by the way, the markets right now, if I look at the S&P 500, it is still over 4,000. It peaked out at 5,000. So we're not that far off the peak in order to make them fearful. If we were at 2,500 and they're going to start to increase more and more and more, then you could say, no, they don't want to do that because they don't want to spook the markets. That's not the case right now. Not at all. We have this, there's this comparison between, what happened in 2008, 2009 and today. Many different reasons why things are happening today than 2008, 2009. But just looking at the markets themselves, and this sets up what we see with the technical indicators, because we did see this bounce. We saw it coming in here, what many were considering this to be a bear market rally. We only know in the rear view mirror if that's the case, but ultimately what you can see here is that this was not sustainable. And what was happening here is because there was just too much bearishness, everybody on one side. And so there's always going to be traders taking the other side, and they started to pile on. What was very unusual, and which I've highlighted before, was that this, is those names that were so hot in 2020 that became hot again. And that is when you got a problem, because it's not the strong companies. It's not the ones that you could say, you know what, they're going to be good in 5 years from now, 10 years from now. It's just all about nonsense, and that's not a good thing. Looking at it over the week, what happened? Energy was the only one that was up, and it was up quite a bit as a result of the price activity on the 23rd. But you can see markets really got slaughtered no matter where you saw this, okay? Big time. Now you stayed into this point. I want to give you what's happening with the most accurate analyst, and let's begin right here. You could see Mike Hartnett and what he had to say. This is the big one. Okay, I'll give you the biggest one right up front. Quote, higher unemployment most likely a catalyst for end of retail buy the dip. That's right. So buying the dip is what's going on with retail right now. They're pouring literally billions of dollars on a global level into the markets, and that just shows us that they have this insatiable appetite and they have the desire to see a repeat pattern of 2020. So during this period, we've seen unemployment rate being so low. If that changes and starts to elevate, according to Mike Hartnett, he believes that this is going to be a big, big difference for what the retail traders believe. Bond double top holds the key to near-term stock resilience. So this is also what he had to say. If bond yields double top in the next 4 to 8 weeks, where the 10-year Treasury yield fails to exceed 3.48%, the quote autumn narrative becomes peak yields equals peak spreads equals no new lows in stocks. So we'll see. I'll cover that data for you if you watch on the channel. These are a lot of bond market technicals and everything, but I just wanted to show you that what we're seeing here is a huge shift that's occurring. Is this really the part in which we start to fall lower and lower and lower, or is it going to just chop around for the next little while? We're at that pivotal moment here. And so, they're just basically saying, Bank of America says investors wary of the Fed pull money from stocks and bonds. That's just in this, initial trading session. But I would be interested to see what happens in the coming days, the coming weeks and months. And why is that? Because If you look around the world and if you see the activities of normal everyday people, it's starting to be dramatically affected by what's happening. And the central banks need to act. They need to do something. They need to take action because, as you see here in this case, Britain to see 80% spike in energy bills as the crisis deepens. 80%. I showed you what happened with the United States. 20 million Americans are not able to pay their energy bills. Then we have this. Finns are urged to turn down their thermostats this winter, take shorter showers, and spend less time in their beloved saunas as Europe faces an energy crunch following Russia-Ukraine. Okay, it's unbelievable. You have to suffer. You, the individual, have to suffer. Do those roaming on their private jets to Davos have to suffer? Absolutely not. But you pay all your taxes. You're giving all that money to the taxes. Where does it go? I thought this would help the infrastructure. I thought this was going to provide me with the future. They're getting rid of all those protections that you had in place, and it doesn't matter where you live. Sure, certain areas will be worse than others. But you got to understand this. Your tax dollars get converted into stuff for the MIC, military, and then it gets dropped elsewhere. Until you realize that and you actually look and watch where the stuff goes and how this all works, it's a mystery to most people, but that is the case, the vast majority of it. And then we have this, I'll end off with this. More than 70% of pubs do not expect to survive winter as energy costs soar. Independent brewers and pub operators warn of doomsday scenario unless government takes urgent action. This is significant, of course, because you could just see that regular businesses are being affected by inflation rates, by the cost of living situation that we have today. I mean, this is unbelievable, is it not? Is this not a concern that you see prices elevating so high? And so the central banks have to increase interest rates. They have to keep it up. How long they can keep it up for? That remains to be seen. Did you appreciate the video? If so, you got to subscribe. I've got more details coming. You want to check it out in the next one after this. So make sure you subscribe. Take care.